Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that's a game changer for so many investors. Exchange-traded funds, or if you've ever felt overwhelmed by the idea of picking individual stocks, or you're just looking for a smart, simple way to build a diversified portfolio, then you are in the right place. We're going to break down what ETFs are, why they're so popular, and ILL even share some specific types of ETFs you might want to consider for your own investment journey. So, grab a notebook, because by the end of this video, you'll have a clear roadmap for getting started with ETFs. First things first, what exactly is an ETF? Think of it like a basket of investments. Instead of buying one single stock, like a share, in Apple or Amazon, an ETF allows you to buy a whole collection of stocks, bonds, or other assets all at once in a single trade. For example, an S&P 500 ETF holds shares in the 500 largest companies in the US. So by buying just one share of that ETF, you instantly own a tiny piece of all 500 of those companies. Pretty cool, right? This brings us to the biggest benefit of ETFs, instant diversification. We've all heard the saying, don't put all your eggs in one basket. Well, ETFs are the perfect example of that principle in action. If one company in the fund doesn't do well, it's balanced out by the hundreds of others that are. This helps to spread out your risk, which is a cornerstone of smart, long-term investing. It has a much safer approach than trying to hit a home run by picking just one or two individual stocks that you hope will take off. Another huge advantage is the low cost. ETFs are famous for having very low expense. An expense ratio is just a small annual fee that the fund charges to manage everything, compared to many traditional mutual funds, which can have higher fees that eat into your returns over time. ETFs are incredibly costly. We're talking fractions of a percent here. Over decades of investing, these small differences in fees can add up to tens of thousands of dollars in your pocket, not the fund managers. And finally, they're super easy to buy and sell. ETFs trade on stock exchanges just like regular stocks. This means you can buy or sell them anytime the market is open, using any standard brokerage account. This flexibility is a big plus compared to some other types of funds that might only let you trade once a day. Alright, now for the fun part, let's talk about some actual ETF ideas to get you started. Please remember, this is for educational purposes and not financial advice. You should always do your own research. Let's start with the foundation of many portfolios. A broad market index ETF, a great example is an S&P 500 ETF. We mentioned this earlier. By investing in one of these, you're essentially betting on the long-term growth of the entire US economy. It's a classic for a reason. These funds are diversified across all major sectors, from technology and healthcare to finance and consumer goods. For most people looking for a simple, set IT and forget it, core holding, this is an excellent starting point. It provides stable, steady growth potential over the long haul. Next, let's look beyond the US to be truly diversified. You need some international exposure. An all-world ex-US ETF does just that. It invests in thousands of companies from developed and emerging markets all across the globe, but it excludes the United States. Pairing this with an S&P 500 ETF gives you a truly global portfolio. You get exposure to European giants, Japanese innovators, and the fast-growing economies in Asia and Latin America. This helps protect you if the US market goes through a rough patch while other parts of the world are thriving. Now, what if you're a big believer in innovation and want to focus on high growth potential? This is where technology sector ETFs come in. An ETF that tracks the NASDAQ 100 index, for example, gives you concentrated exposure to the 100 largest non-financial companies on the NASDAQ exchange. This means you're investing heavily in the big names in tech, like the ones you use every day. These funds can be more volatile than broad market ETFs, meaning their prices can swing up and down more dramatically. But for investors with a higher risk tolerance and a long time horizon, they offer the potential for significant growth by tapping into the most innovative part of the economy. Let's not forget about bonds. While stocks are for growth, Bonds are often for stability and income. A total bond market ETF is a great way to add this stability to your portfolio. It invests in a wide range of government and corporate bonds with varying maturities. When the stock market is volatile, bonds often hold their value or even go up, acting as a cushion for your overall portfolio. This balance is key, especially as you get closer to retirement. Having a portion of your money in a less risky asset, like a bond ETF, can provide peace of mind and a steady stream of income. Finally, for those who want to invest in something tangible, there are real estate ETFs, often called ETFs. These funds invest in companies that own and operate income-generating real estate, like office buildings, apartment complexes, shopping malls, and data centers. This allows you to invest in the real estate market without the hassle of being a landlord. REITs are also required to pay out most of their income as dividends, so these ETFs can be a fantastic source of passive income. It's a great way to diversify your portfolio even further into a completely different asset class. So, how do you put this all together? A common strategy is to build a core satellite portfolio. Your core would be a large holding in a broad market ETF, like the S&P 500 or a total world stock market fund. This forms the stable foundation. Then, you can add smaller satellite positions in more specialized, like a tech fund, a real estate fund, or a specific international fund, based on your own interests and beliefs about where future growth will come from. For example, a simple portfolio might be 60% in a total US stock market, 20% in an international stock ETF, and 20% in a total bond market ETF. This is a classic balanced approach. The beauty of ETFs is that you can customize your portfolio to perfectly match your goals, risk tolerance, and timeline. Are you young with decades until retirement? You might lean more heavily into growth-oriented stock ETFs. Are you nearing retirement and focused on preserving your capital and generating income? Then bond and dividend-focused ETFs might make up a larger slice of your pie. The most important thing is to get started. Don't fall into analysis paralysis where you spend so much time researching that you never actually invest. Open a brokerage account, start with a small amount, and buy a share of a simple, low-cost, broad market ETF. You can learn and adjust as you go. Consistency is key. Investing a little bit every month, a strategy known as dollar cost averaging, is far more powerful than trying to time the market. So, there you have it, a complete beginner's guide to understanding and choosing your first ETF. We covered what they are. Their amazing benefits like diversification and low costs. And we explored several types you can use to build a robust portfolio, from broad market index funds to specialized sector and bond funds. I hope this has demystified the world of ETFs and made you feel more confident about taking control of your financial future. Thank you so much for watching. If you found this video helpful, please give it a thumbs up. And do you want to forget to subscribe to the channel and hit that notification bell so you do? Don't miss our future videos on investing and personal finance. If you have any questions, or if there's a topic you'd like me to cover next, drop a comment down below. I love hearing from you all. Thanks again, and I'll see you in the next video.